Good afternoon and welcome to the CALNEX Solutions PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Tommy Cook, CEO. Good afternoon, sir.
Hi, thank you, Lily. And good afternoon, everyone. Thanks very much for taking the time to hear the update from CALNEX on the results of FY23. Before we go into talking about 23, let me just take a couple of minutes for the people that may be less familiar with CALNEX to just go over who we are and what it is we do. So CALNEX makes test instrumentation primarily for the telecommunications industry, but more and more for anyone that's running a telecoms type network, whether it's in a data center or in an enterprise as well. Fundamentally, all our customers use our equipment to prove performance and conformance of their equipment to the performance that they expect from their network or their equipment. We already have a global footprint. We've sold in 68 countries around the world, and we run a lean business model and use global distributor channels to create that footprint together around the world. If you look at our customer sets, it breaks into kind of four main buckets. Top left is the telecoms equipment vendors. So you get companies in there that you'll recognize like Nokia, Ericsson, Cisco. So we sell into their R&D teams where they are developing pieces of equipment and they need to verify performance before they release it into production. That group represents roughly around 55% of the business that we generate. Then bottom left, we have the network operators. Again, familiar names, AT&T, BT, China Mobile, that run the large networks. Again, our business is split in two parts there. One part we sell into their R&D teams that evaluate new equipment prior to deploying in the network. And we also have maintenance products that we'll talk about through the presentation as well. The third group in the telecom space is bottom right. That's the component manufacturers, Intel's, Broadcom's, Qualcomm's of this world that make very sophisticated chipsets. They sell their chipsets to the equipment vendors, they build them into equipment, then sell products on to the network operators. And they represent around 6 or 7% of our business. I think I forgot to say the operators are around 15% of our business. Then the last part that's a growing part and currently around low 20s, 23, heading to 25% of our business is what we've termed hyperscale and enterprise. So these are either large companies running their own networks, but also of great interest are the companies that are running the big data networks of the world, or data centers. And these are a focus for us, as we'll talk about later. If you look at the life cycle in terms of why do people need to test, well, at every stage of a life cycle, building new equipment through to manufacture, through to building networks, maintaining networks, there's a need to test. The areas that we focus on are highlighted with the red circles there, and it's primarily what we call design validation and conformance tests. So this is the R&D teams. They're building a new switch or a router or a piece of mobile equipment. And as they get the first prototypes back or the pre-production units, they need to fully verify that the equipment's working and it'll work under all conditions. Once it's deployed in the real world, they've got good design margins so that they don't end up having manufacturing issues with a low yield. And also if they're claiming conformance to international standards, again, they need to prove that they actually do meet these standards before they start shipping to their customers. The other part that we focus on is in the far right here is what we've called monitoring and maintenance. To date, we've actually been focused on the maintenance part. So this is after, for example, a mobile network out there. If there's a problem at a base station and a base station won't work correctly, then they have to send their engineer out to understand what's going on so that they can verify correct the problem. The other part that we're looking at now is monitoring as well, where you've got actually a deployed monitoring system that actually touches most of the nodes in the network and sends information back to the central system to say that there's a problem or there's an issue out at a particular node. Again, we'll talk about that a lot more later on. So CALNEX is really, since we floated in just over 2.5 years ago, since we floated on the AIM market, through that time, we've proven that we're a profitable cash generative business. And we've got a robust balance sheet. We're considerably larger than we were 2.5 years ago. We've had 3 years where we've grown very healthily, both in revenue and profit and in terms of staff size as well. And key to us, and we'll talk a lot about this later, is the strong customer relationships that we have and also relationship with our partners across all territories. We have a large expanding addressable market and challenged, as all businesses are, to keep growing that as we move forward. And although at the moment, as we'll talk about, there are some challenges in our sector where the kind of macroeconomic effects are slowing down spend or making some of our customers be more cautious with their spend in the near term. Underneath that, we believe we're in a good place because the drivers for the networks that we're involved in, or the parts of the market we're involved in, remain healthy. The build out of the mobile network, often referred to as 5G, the move to cloud computing, the need to build data centers to host the cloud computing and then put test services running in cloud computing are all continuing to grow and show no sign of slowing down. And so our markets remain very healthy. So that's who CALNEX is and our whistle-stop tour. So let's just talk about last year, FY23. Well, we are really pleased with what happened in 23. It was a great year. We grew our revenues 25% to 27.4 million, and profit pretty much aligned up 21% in that period to 7.2 million. And we generated cash with a healthy closing cash balance of over 19 million. And we, at the AGM in August, we will propose a final dividend of 0.62p per share. And it's not only, I say it was a great year, and it's not just because of the numbers, but also from an organisation point of view, we had a great year. We've been growing a lot lately, and as you continue to grow, things need to change to deal with the different challenges you get. And we've gone through a number of changes within the organisation, which have all been successful. And now, as an organisation, we feel we've matured and grown over that period as well. One of the biggest issues we had to deal with last year, the same as everybody in the technology sectors, was the problem with the supply chain component shortages. And if we look back now, probably this time last year was probably the darkest hour. It was really a torrid time for our manufacturing teams, working with a contract manufacturer and our R&D teams, trying to manage, get components, if you couldn't get them, get replacement components. But I'm pleased to say it is much better now. I'm not saying the component industry is back to normal, but it's definitely in a much healthier place. And all our products now are back down to normal lead times that we would expect and not the extended ones that we were managing last year. And the team really did a great job of getting us through there. And it really was down to that relationship and strong relationship we have with a contract manufacturer, Kelvinside, that allowed us to work closely with our procurement team and interface with our operations and our R&D team to deal with the many, many challenges these guys had to deal with last year. But through that time, we've continued to innovate in our products, and you'll see later on that we've got a number of new releases and new things that we're coming out with. And of course, one of the key things that we're trying to do is strategically grow our relationships with the hyperscale customers. We've had some early success with these guys, and we believe there is a number of opportunities in there that we continually want to build relationships, develop good relationships with these customers, and then hopefully convert that into healthy business as we move forward. And we've made good progress over the last year. We already have a strong relationship with one of the hyperscales. We have seed units into two of the other ones. These are early units into their R&D team while they're evaluating the need, whether they want to put timing synchronization across the data centers or not. And we engage very closely with them and help them do that evaluation and make sure we're seen as the partner of choice if they choose to go ahead and do that. M&A has been part of our strategy, and for a number of years, in April last year, we acquired iTrinegy in Stevenage. And year one was very much about the integration of that team, building out the team over the period so that we're ready to create growth this year. And I would say that we're pretty much on track with the roadmap we laid out. The team's almost twice the size it was when we acquired them. We've put people into sales, into business development, into product marketing, as well as engineering to really round out that team and make sure we had a strong team. And this year it will be about trying to really push and make sure we can create good growth into that new set of customers for us. So at that point, I'm going to hand over to Ashley, and she's going to cover the financial review.
Thanks, Tommy. So just before I take you through the financials, I thought it would be useful to briefly remind you of our revenue model, as I've done in previous presentations, and it will also be good for those of you that are new to CALNEX just to understand our revenue drivers. So CALNEX generates revenues through the sale of bundled hardware and software, as well as software support and extended warranty programs. So a typical customer will come to us to purchase one of our hardware products, and within that sale, there'll be a number of software options included at the time, and that is invoiced as one bundled sale to that customer. That same customer can then come back for upgrades or additional options that are then added to the existing hardware through the provision of a license key, and we sell these as standalone software sales or upgrades. And bundled hardware and software sales pricing can differ for each order, as it really just depends on what hardware product is being purchased and the numerous software option choices that each hardware product can offer. It really just depends on what each customer wants to purchase, combination-wise for what they need. And that revenue is recognised on dispatch or delivery of the software license key if it's a standalone software upgrade, and makes up 90% of our total revenues. And you can see that from the graph in the top left of this page here. And that has effectively been the trend for the last few years, and you can also see that in the trend. The trend is showing there for 2021 and 2022 as well. Each of our products comes with a standard warranty period, which can be extended for an extra fee. And we also sell software support programs, and that makes up the other 10% of our revenues, as you can see here. And that revenue is recognised over the life of the product. And moving across the top of this slide to the middle pie chart, as you will also know, our revenues are generated across a global customer base and distributor network. And in the past few years, we've had an almost even split of orders and revenue across our 3 geographic divisions: Americas, North Asia, and rest of the world. And that just helps give us a spread of risk. This last 2 years has seen a slight decline in the portion of total orders coming from North Asia as a result of the continued US-China geopolitical tensions. Although, as you can see from the chart, this region still contributed 27% of total orders on average over the last 3 years. I'll come back to the geographic split in just a minute on the following slide. And as you'll remember from previous presentations, and from what Tommy just said on slide 3, our sales are predominantly derived from telecoms customers, where the end application is a telecoms network. However, and non-telecoms customers, as Tommy was saying, include those hyperscale data center and enterprise customers. At the top left here, we show that on a 3-year average rolling basis, and at this moment, and this graph here excludes our recent acquisition just for a second, because just to get a like-for-like comparison, these non-telecom customers represented 25% in FY23 compared to 23% in FY22. If you add back in the sales of any one, our acquired product in FY23, the 3-year average percentage of non-telecoms rises to 26% in FY23. So just moving on to the bottom of this slide, to the left-hand, starting from the left again. As you'll see from previous presentations and from what Tommy just covered on slide 3, our customers are some of the largest in the industry. And over the last 3-year rolling period to March 23, our top 10 customers contributed 47% of total orders. And in addition, the average length of relationship we have with our top 10 customers is 10 years, although there are customers within that top 10 that have been with us much longer. And that just demonstrates the repeat nature of the business that we do with them. We'll see customers come back to order from us frequently, as they may want to order different bits of kit for bits of the same kit for multiple sites. They might want to add new kit as they grow their labs and testing requirements. They might want to add new software options or upgrades, as I just talked about, or they might want to move on to our newer products and functionalities they release to the market. And repeat revenue demand is a metric that we measure across the whole customer base of CALNEX, not just the top 10. And that's what we're showing here in the middle chart here at the bottom. You'll see here the 3-year rolling profile for repeat orders generated across the whole group were on average 74% of total revenues. And in FY23, we received orders from 305 customers, an increase on 233 customers in FY22. Both metrics here have the effect of any one customers being introduced into the mix in FY23 as well. And there's just a case study here that I won't cover in detail that we've shown before, but just shows the nature of a typical customer and their life cycle with us, or their history of trading with us. and the makeup of them buying hardware and software upgrades and how that contributes to the revenue and orders that we get from a typical customer. So just moving on to the detail on the geographic and product performance in the period. So this is this year specifically, as opposed to averages. So you'll see from the disclosures and notes in the RNS that we released yesterday, the rest of the world region for us was our biggest performing region in the year. And in particular, within that region, Europe contributed to the majority of the growth within that region. In the North Asia region, just mentioned, has been operating against the backdrop of the US-China tensions, which remain in the region. And as a result, China specifically is a challenging country for us within the North Asia region as a whole. However, we've seen a strong performance in Taiwan, and there's continued ongoing potential in both Taiwan and Japan. The Americas revenues saw growth in the year, which you'll have seen from the numbers as well, and there was a strong start to the year. However, orders were impacted in the latter period due to the challenging macroeconomic environment we're dealing with. Just on to the product line revenue drivers. We experienced revenue growth across all of our major product lines. LabSync growth has been driven by PAM4 release, as well as underlying growth in existing platforms. Network Sync, which includes our Sentinel and Sentry products, has performed very well as a result of the diversification of our customer base within this product line, which now includes data center customers Tommy talked about earlier. And Cloud and IT saw good organic growth from S&E sales, as well as incremental growth from our newly acquired product, the ME1. So just onto the income statement itself, just to bring that together, you'll see the revenue growth was 25% in the year, growing from 22 million to 27.4 million. We did see an incremental beneficial foreign exchange effect to total group revenues, which I mentioned at the half year. And that was obviously as a result of the strengthening of the US dollar over sterling in the period. So 80% of our revenues are US dollar generated. And as a result, just over a third of our revenue growth on the previous year came from positive currency movements. At the same time, we saw the supply chain delays easing, as Tommy was mentioning earlier as well, in H2. And as a result, our order backlog, which was higher than normal at the half year, unwound over H2, allowing us to meet our revenue targets for the year. Gross margin was 76% in the year, and that's in line with the prior year margin. And as a reminder, that is gross margin that is net of commissions payable to our channel partners. We saw a rise in costs as a result of increases in component prices and general inflation over the period. However, we were able to increase our pricing through discussion with our distributors earlier on in the year, which helped maintain our gross margins. I'm just moving down to underlying EBITDA for a second, and then I'll step back to talk about the costs that sit within that. This is EBITDA stated after charging R&D amortization. Because our R&D amortization is such a large component of our P&L, we like to put this second EBITDA KPI within our P&L just to aid the reader in understanding our P&L drivers. So as you can see, underlying EBITDA grew by 1.6 million in the year, and that's driven by the trading performance, the revenue performance on the top line. Margins were 29%, which is in line with last year as well. And that is also against the inflationary increases in external cost pressures within the non-direct cost base as well. So we were also able to maintain those profit margins at that level as well, which was great. Large cost component, as you can see, of underlying EBITDA is administration costs. So administration costs in this table excludes depreciation and any amortization because they're shown on separate lines. That was 9.9 million in the year, and that, as you can see, was an increase in 2 million on the prior year. This increase includes the planned investment, including run rate from the previous year as well, in management, sales and support teams across the business, which was all in line with our growth strategy at the start of the year. We also saw an expected increase, which again was budgeted for, in travel costs as COVID-19 restrictions have been lifted across the majority of our regions. And we also saw a small incremental increase in overheads as expected as well to the Stevenage site, as a result of the Stevenage site, after the acquisition of iTrinegy. So we have an additional site now from April. The majority of our overhead costs are sterling based, and with the exception of our overseas sales teams. So as a result, the group's overhead cost base in general has not been materially affected by FX movements. But there has been some FX movement, as you might expect, within our overseas sales teams, especially the ones based in the States. And as you'll know, we capitalise 100% of our R&D costs currently and amortise these to the P&L over 5 years. Amortisation of R&D costs, as you can see here, was 3.3 million in the year, and that's versus a cash cost of 4.5 million, which I'll cover in a second in the cash flow. And the increase on the prior year is similar to previous years. It's all due to the planned ramp up in R&D headcount in the year, but also previous years, just due to that 5-year amortisation profile, and that's all to support our growth strategy and project plans. Profit before tax, as you can see here, was 7.2 million in the year, and the margin was 26% compared to 27% last year. The small difference there was due to an increase in intangibles amortisation, which will be the same number for the next 5 years, due to the us bringing on a 1.3 million of intellectual property intangible asset as part of the iTrinegy acquisition, and that asset is amortised to the P&L over a 5-year profile. That adds 0.3 million to that number. The effective tax rate for the period was 18%. So the increase in corporation tax rates and underlying corporation tax from 19 to 25% is built into that. However, we were able to benefit quite well from the R&D tax credit schemes that are available to us. So that got us back down to the 18%. And earnings per share, as you can see here, saw good growth. The majority of that is driven by the revenue, the profit performance, but we also saw an incremental increase in benefit to that because of that change or because of the decrease in the effective tax rate. And just on to the cash flow, I'll just pull out some key items here. You can see from the cash flow summary, 3.7 million of a cash inflow in the year, and that total cash figure includes the net 2.3 effect of the acquisition of iTrinegy, which we funded from cash balance. And that just demonstrates the strong underlying cash generation in the period. So pre-acquisition, our cash generation was 6 million in the year. Net cash from operating activities was 11.1 million in the period. Working capital movements can differ year on year, just depending on the timing of when we get payments in from our distributors, which are on set days. So often happens just a couple of days after the year end or a couple of days before. An outflow of 0.5 million was expected, and that's just predominantly as a result of the timing and volume of shipping and invoicing to customers. So no surprises there. Key cash flow items, moving down the cash flow. As I mentioned before, cash spent on R&D activities was 4.5 million, and that's all capitalised and amortised over 5 years, as I mentioned previously. The dividend was, the dividend here is the combination of our final dividend paid, or final dividend for FY22 paid in August, and then the interim dividend for FY23 paid in December. And as Tommy mentioned earlier, we're proposing a final dividend, and if approved at the AGM, that will be paid at the end of August. So just moving down, the other things just to mention here, the 2.3 million net cash impact of iTrinegy, which I've covered. That was the acquisition that completed on 12th of April 2022. That was 2 entities that we acquired as part of the acquisition, iTrinegy Limited and iTrinegy Inc., and both will be hived up into the CALNEX UK entity quite shortly. And then we put surplus cash balances, as we've said before as well. We've done this for a couple of years now. We put surplus cash balances into high interest deposit accounts. Under accounting rules, you have to show some of them as a fixed term investment. So you'll see that there's two cash balances effectively on the balance sheet. We pull them all together on this cash flow here. So to us, closing cash, including fixed term deposits, was 19.1 million, which just gives us a really healthy cash balance to take into this current year now. And still no debt on the balance sheet, and we still have our 3 million RCF sitting there, still not utilised since we opened it up as part of the IPO. And just the last slide here, I'll just touch on really briefly. It just gives you a bit of a flavour of the kinds of things that we're doing around ESG and the progression that we've made in the year around ESG in general, particularly the environmental and social aspects of it. We follow the QCA guide to ESG for small to medium-sized entities from a framework perspective and from the perspective of embedding an ESG methodology within the business. But we also work very closely with our investors to understand what's important to them with regards to ESG. We've recently been scored by one of our investors using the Integrum framework for ESG scoring and came out with a rating of very good, which is the second rating down, which for a company of our size and for our first go at being scored, we were very pleased with. Just a couple of things here. We've created a corporate giving scheme, which we created at the start of this year, at the FY23 year, sorry, and that's 1% of our budgeted profits are allocated to this fund. It's employee-led, where employees are encouraged to propose charities or organisations for us to donate some of the fund's money to. And as you can see here, our fund of £70,000 this year was used to donate to 84 different charities and organisations across not just our local head office area, but any area that's local to our employees, wherever our employees are located, which is core to our goal to making a meaningful impact to our local communities, either from a social or environmental perspective. We also continue to, and we always have, we're continuing to invest in training to enhance skills, leadership development, mental well-being awareness across the organisation. We're also working with external bodies to support the future of talent and engineering. Our products are innovative, leading-edge solutions, as you might already know, minimising the impact on the environment for our customers, and we're continuously looking for ways to reduce the impact on the environment from our own product manufacture process. And there are various projects happening within the business to understand what kinds of things that we can do that are within our control within the business model that we have to try and reduce, not only reduce our environmental impact, but also help us understand and gather data and report on our environmental impact as well. So that's everything from me. I'll pass you back to Tommy to talk through the strategy.
Thanks, Ashley. So let's have a quick look at the strategy and I guess in particular what's happening in the market and what we're doing to try and increase our addressable market. As we all know, back in March, we had to downgrade our forecast for FY24 because across the board, as we've been seeing exact same as the other big players in the test equipment market space, that customers are becoming more careful in terms of their spend on capital equipment, and most of our equipment is bought out of capital equipment. And very much this is the way that our customer base, I've seen over the many decades I've been involved in this, that's the way they behave when they get concerns and they slow down capital equipment spend, because it is the easiest lever to pull. And it really seems to be driven by the macroeconomic situation, not by sector-specific problems. In fact, when you look at some of the reports coming out, it still shows that there's a growth, the growth remains healthy in the build out of the mobile network, that there is a need for that. And also then from a data center point of view, again, there's a real need to expand these data centers and increase the numbers out there because of the amount of utilization that people want to use in cloud computing. So from a market point of view, we continue to see that our fundamental drivers across our markets, our core markets, are still there. They haven't really changed. We are in a tighter situation where customers are delaying spend. But again, from a funnel point of view, we are starting to see a longer term funnel building. The big question is, when's it going to convert? So deals are being delayed. We're not seeing any deals cancelled. Things that are in a funnel, suddenly, you know, the engineering teams that we're working with are being told they're not allowed to buy anything at the moment. And we work closely with them, and it's an opportunity to strengthen relationships because they're having a torrid time as well. They want the equipment, but they're being restricted from getting it. So we sometimes lend them equipment, but we continue to build that relationship so that when they do get the chance to start to spend, our PO is quite close to the top of the pile and one of the first ones to cut. So the market remains strong. Definitely the global macroeconomic effects is affecting us in the nearer term, but we still believe we've got a strong market. But in doing that, so from a strategy point of view, This strategy slide's the same as it's been for a number of years. We continue to see that the two key markets that we're going to track is looking to innovate products to capitalise on the growth of 5G or the mobile network build-out, and also from the cloud computing, both from focusing on the building of the infrastructure to create data centres, but also focusing on testing services and applications that run on top of the cloud service, cloud network, as opposed to in office. So these markets remain strong and remain our key drivers. We continue to look for M&A. As you know, we acquired a company last April, as Ashley was saying, and we've continued to look for other targets. And we've had some interesting discussions through the year. As I've said before, it's a sector there isn't thousands of companies making test and measurement. There's a few, but we are being a lot more systematic at going round. And when we see a company that's the right for us, that creates new business, and my definition of new business is takes us to new customers, or allows us to sell something in addition to what we're already selling to our current customer base, then that's what will be the fundamental driver to take forward an acquisition and bring them into the company. So if you look at a product portfolio, for people who have seen this before, it'll look quite different. And I'm going in the next slides talk about the changes in a bit more detail. Our lab sync, which remains a key product for us, there's been a number of enhancements over the year. Our platforms stay the same. But in the network sync, there's two new platforms we've got. We've got the Sentry product, which is more focused on testing networks within data centers. Remember, a data center is almost just a big network in a building. And so it's the same product, a similar product to Sentinel, but more focused on what the data center guys need. And we've got a new product that we've literally just launched called Sync Sense, and I'll come back and explain a bit more what that is. And then when you look at a cloud and IT, there's quite a change here, because now we've got 3 versions of SNE. We used to just have 1. And again, I'll tell you why we've got 3 in a minute. And of course, we got the NE1, which came from the acquisition last year. So what I wanted to do is just take a couple of minutes to try and express how we find new opportunities, either selling more of the products we have, but also trying to expand the addressable market for the current products we have, but also looking for new products and how that comes about. Because there are a few interesting dimensions to the world that we live in terms of how we continue to move forward. First of all, if you look at one of our main products, Paragon Neo, or the LabSync product, we are dominant in that market. We're the market leader. We're regarded as the de facto standard for high accuracy time transfer testing. And today we cover every interface. We can test every interface from 100 megabits up to 400 gigabits. And in terms, as you can see in the top left there, the standards, the ITU-T have standards that cover this technology, so does ORAN, and they're continually moving these standards. So we have a continuous program of enhancing our product, because our customers need to, when new things come into the standards, then they need to prove that they conform to these standards. So we have an engineering team that continues to release things once or twice a year, enhancements to the product. But every so often we need to make bigger steps forward. And we've just started our work. Today, the highest speed interface that's just arrived in the network is 800 gigabits. And now we can get access to the technology that will allow us to deliver 800 gigabit support in the Paragon Neo. So we've just started a project now, and that'll deliver mid FY25. So I wouldn't expect it'll definitely have any impact on the revenue this year. We may get the early order, but it's really about FY25 where that'll make a difference. But you know, the whole movement in terms of to higher and higher rates in telecoms just continues incessantly. And later this year, we'll put a small team on starting to investigate the technology to add 1.6 terabit interface support to Paragon. Now that's not going to get launched to FY26 or 27. It's way down the road. And in fact, in a couple of years, we'll start working on 3.2. And you may say, how do you know you're going to do that? And that's because really, in my time in telecoms, there's been 14, 15 generations of the next higher rate. So really for telecoms to not go to the next higher rate is a discontinuity. Going to the next higher rate is not the discontinuity. It's the natural thing to do, because the demand is there and technology pushes forward that allows them to move higher and higher bandwidths of data at more cost-effective prices. So you can see here there's a long-term plan. There's a roadmap for this product. There's an element that changes every year as things change in the standard, but there's also a long-term plan for the product to actually follow the wave and continue to ensure that we stay the market leaders. If you look at our network emulation products, In the past, we had the SNE and we had the Atero. We first introduced the Atero over 10 years ago. And then we acquired JAR in Belfast, and that's where the SNE came from. That was back at the end of 2017. But we've now moved the whole portfolio across onto that platform, and we've generated 3 versions of the same platform, the SNE, the SNE-X, and the SNE Ignite. So why have we done that? And it's really because there's a huge range of potential applications that we can target with this product. There's many people for many different reasons need to emulate networks to allow them improved performance. And they all have slightly different requirements. So the SNE Ignite is a hardware-based implementation. So it's used for applications that really need high accuracy performance, and people would buy that product. And then we have the SNE at the lower one of the 3 there, which is more about low speed applications, but need high complexity in terms of the networks they emulate. And we have that product. And then in the middle, we've created the SNE-X, which really sits in the middle and addresses the high port density applications. And the reason we do that is it allows us to create collateral that presents these products to customers very much the way that they need to understand it so they can see the value in what they do. And it also allows us to price the products in the market to make sure we maximize the potential for the company. So now we've got a full range of products there that we feel, and SNE Ignite really replaces the Atero in the market space moving forward. And it's a common software platform and a very high degree of commonality in the hardware platform. So it allows us to move the product portfolio wherever we can find applications that we can be successful in. And then, of course, last year we acquired iTrinegy and we got the NE1 product at the bottom. And it's far more focused, whereas the SNE is focused on testing equipment and networks. The NE1 is focused on testing applications that run on top of these networks. And that might seem a subtle change, but there is quite a significant change in the way the product needs to present and the subtleties and the capability that it needs to present to the users that actually need these different products. So really, we're really trying to push this to say that we have this broad portfolio of network emulators that can test whether you're testing applications, testing equipment, low-speed equipment, high-speed equipment, broadcast equipment, any type of equipment, we can actually deliver a solution there. So the NE1 this year very much is pushing to see how we can expand that market. We're going to focus on things like federal and defence, where we know there's a higher degree of spending going on at the moment, as well as things like gaming and enterprise migration that we've been focused on the last few years, again, to expand into new customers with the current portfolio. The third example is to look at the data center world. As you know, we actually were successful in a major win inside one of the big hyperscale guys with the Sentinel product. The Sentinel was designed to maintain telecoms networks. But because the same technology was taken from the telecoms world into the data center world, we were able to take the product across. But of course, it's more, in terms of its form, fit, and function, it wasn't quite right for that application. So we've created Sentry as a new product that's far better aligned to what the data center guys are looking for. It's got a high degree of commonality from a technology point of view with the Sentinel, but it allows us to configure it differently, again, aligned to what these target customers need. And through these discussions with our customers that we've been engaging with, we're seeing an emerging opportunity for monitoring systems that monitor all the nodes. So very much Sentinel and Sentry are there to solve problems. Once there is a problem, you send your engineer across along with one of these boxes. It gives you deep insight and allows you to figure out what's going wrong to fix it. A monitoring system is more like a fire alarm system. It basically tells you there's a problem. So there could be thousands of nodes out there, and basically all that data is sent back to a central point and allows you to then figure out where the problems are. And where we feel like we can get the edge here is when you come to the world of timing, which is very different to virtually every other aspect of telecoms. When you're monitoring other aspects of like links being up or down, the equipment tends to give you a simple, yes, it's working, no, it's not working. And then you can dispatch engineers. In the world of timing, life's not that simple. What you get is a lot of parameters that you have to be able to interpret and compare to what's happening in other nodes to interpret that data and then guide the engineers. And that's because we are regarded as the experts in understanding this. We believe that's where we can get an edge. So this is a brand new product. We've only started to engage with customers in the last month, and we're speaking to the data centers as well as a few pilot customers in the telecom sector to see whether this is a new arm to the business that we can expand into and create additional revenue for the company. And lastly, these are quite big changes that we've talked about and hopefully end up being big changes for the company. But in a lower level, we continue to expand our addressable market. A couple of examples of how we do that. We were successful with one of the tier 1 chip manufacturers that was creating a chipset to test time that delivered operated and supported all the timing protocols. They bought a Paragon Neo from us because they needed to prove they conformed to the standards. We worked with them to make sure they maximised the value of the purchase, which encourages them to buy more. But through that, we actually showed them how they could use our product to demonstrate the performance of their chips to their customers. So they went out on the road and demonstrated it. Of course, that helped us a soft promotion of our product. And so we get additional benefit from their customers coming to us and say, we have seen your product, we need one of them. Because once they take that chipset and build it into their whole system, then the whole system needs to get checked again to make sure it still conforms to the standards. You can't just rely on the fact that the chipset that you bought was conforming, then the whole system would. So you can see how we can expand our reach and get new customers. The second example we have here is a tier 1 equipment manufacturer, a company we've worked with for many, many years. We've sold into many of the labs around the world, and they buy the LabSync products, the Paragon products. But actually, through that strong customer relationship, they actually introduced us to some of their colleagues in the building that actually needed network emulators. And through that, we were able to actually build that relationship, show them what our products did through that introduction, and ultimately sell them the network emulation products as well. And when the LabSync guys go and sell to their customers, in terms of selling their product out to the operators will often ask, well, how are we supposed to maintain this equipment once it's deployed? And they would at times will say, well, you may want to look at CALNEX, they've got some equipment. And so you can see how customer relationships is not an optional extra for us or a nicety. It's absolutely central to our strategy of building a market. We build relationship with customers, not only as Ashley showed you in the graph to get recurring income from this, repeat income from the same customer in different sites, but also to find new opportunities for new products, be there with them, identify that opportunity, and also get into other customers. So to summarise all that, looking back, I guess FY23 really was a great year for us. You've seen the results. We're very proud of the performance we achieved. There was a lot of things happening under the covers as well in terms of inside the organisation that we're very proud of what happened. But unfortunately, at the turn of the year, as we had to downgrade in March, we did see customer spending pulling back. It's stabilised, I would say, but it hasn't perhaps got much better. We basically need to just wait until that confidence comes back into the market. We're continuing to engage with our customers. We don't give up on our customers just because they won't spend. It's the complete opposite. We work closely because they would like to spend and they're frustrated that they can't do it, the engineers and the engineering teams that we speak to. So we try and help them through that time to make sure we build the relationship and we can get business and when it comes back again. We have started to see the orders, the long-term or the medium to long-term funnel building, which shows the demand remains there. And when you look below the hood in terms of our core drivers in the industry, nothing's changed. The driver there, the need and the desire to build out the mobile network has not changed. The need and the desire to expand the number of data centers out there, the bandwidth that they can offer to their customer has not changed. So we believe we continue to be in a strong place. And as you see, we've been working hard to come out with new products. We've got a number of other initiatives to continue to push to ensure that we maximise in a more difficult market than we had last year. You just need to go out there and shake more trees and make sure you get business what's there, but also be well positioned when the business comes back, we can return to growth. So that's the end of the formal presentation.
Tommy, Ashley, thank you very much for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab situated on the top right-hand corner of your screen. Just while the company take a few moments to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we have received a number of questions throughout today's presentation, and thank you to all investors for submitting their questions. Could I please ask you to read out the questions and give responses where it's appropriate to do so, and I'll pick up from you at the end.
Okay, thank you. I'll take the first question. So there's one here from Stephen. Stephen has asked, do you have a target for return on capital for example, ROE, ROA, especially given your capital allocation approach of retaining most of your earnings and continuously deploying incremental capital. So we do have targets, absolutely. We don't publish them, but we are continuously looking and refreshing the way and the way that we target, particularly our return on investment on R&D spend. So from a deploying incremental capital into the R&D side of the business, which is where a lot of, as you can see from the cash flow, a lot of our cash ends up. That is intrinsically linked to where we believe the value is on the revenue side and the order side, in future periods. So we do look at that from a new product perspective, because we're bringing on the new products that Tommy has talked about. A lot of them will have different types of ROI metrics, and because we are growing our different product ranges, we have to come back and look at those ROIs, or the total ROI for the business on a continuous basis. So when it comes to investing cash into R&D, absolutely hugely important that we have these targets. We don't publish them.
Okay. Thanks. Stephen managed to get his questions in early, so I guess we should respect and answer them early. So yeah, the other question Stephen had was, typically, how often do repeat customers place orders with you? At least once every year or every 2 or 3 years? If there's no single typical figure, can you please provide a rough range of orders frequency from your repeat customers? Yeah, really a lot of they tend to spend aligned to projects. So if you look at most of the projects that the customers that we work with are working on, they'll run for anything from a year to perhaps 18 months, even 2 years if it's a really big project. And so individual teams tend to buy associated with projects. So early on, as they start to know that they're going to have equipment to test, then they'll buy, and until they start the next project. So what you see is really within a team that sort of cycle. Now, somebody like a big customer, one of the big tier one equipment manufacturers, they have 10, 15 teams around the world, and sometimes each of them are running multiple projects. So that's why you see like that picture as a kind of spiky spend pattern, because there is a bit of when do these happen. Sometimes they line up, sometimes they don't. And if it's a smaller company, then again, sometimes it is more the 2 or 3 year time that they'll buy something. They may come back and get minor enhancements. And it's also dependent on what's happening in the standards. So they may buy a product and it may be 2 to 3 years before they buy another platform product, but they may buy enhancements during that time, because if the standards have changed, then when we put enhancements on from the standards, then that's a charged upgrade, and they'll upgrade at that time as well. So that's sort of kind of, if you kind of relate it to our customers, what they're up to, that kind of 1 to 2 year period is a good indicator, because really, as I said, it's about buying aligned to their fundamental needs as they start and progress through projects. You got another question, Ashley?
Yes. So William has just asked what our market expectations for FY24 with regards to revenue and EBITDA are. So we have the guidance that's in the market at the moment has the revenue, just given what's happening in the wider macroeconomic situation. We have just over a 10% decline in revenues compared to this year, is the market guidance. So it sits at 24 million, the revenue and the guidance at the moment. That comes down to, so I'll give you a couple of EBITDA figures because of the fact that we show underlying EBITDA as well. So that comes out to about 8.5 million at EBITDA, pure EBITDA level, and just under 5 million at the underlying EBITDA level. So profit before tax, which is one that we also track quite closely, the margins on profit before tax will be sitting closer to this 17% level compared to where we've been recently at the 26% level. Hopefully that gives you a bit of detail there.
And James, a question here as well. You previously referenced the constraints on the customer budgets. Do you have any visibility on when that might change, and anything you can do to influence this, i.e. pricing? Yeah, I wish I knew, James. You know, at the end of the day, it's really the confidence coming back into these larger organisations that they release the budget. You know, the people that we work with and primarily sell, you know, there are a number of layers down from where these decisions are made. When it comes to pricing, you know, unfortunately in this sort of situation, it's not about the price. So to suddenly give a 10, 15% discount, it won't ease it. It's just they're not allowed to spend the money and they can't get it through the procurement department or get it authorised up to the level. And in fact, it's dangerous to lead with discount because they'll take the discount, but then you'll still get the order next quarter just with a discounted. So all we can really do is, you know, keep working. There will be, quite often the situation is that it's not an absolute can't spend a penny. It's just as an extremely high bar and a very small budget. So in cases that where it becomes critical, we can support them in terms of creating an argument to the managers or the budget holder to encourage them to put the money there. But it's really, there is an element of waiting and for it to come. But we, you know, in terms of in a particular deal, if they can't get it out, but it is about continuing to build that relationship so that we do help them. We might lend them the product. And again, sometimes you lend them the product that they can then it makes it easier for them to demonstrate to the manager or the budget holder how this is going to make such a difference if we just had it. And that's the sort of kind of low level things that we're doing. Have you got another question there, Ashley?
Sure, yeah. Gareth has asked, are any staff members still working remotely, or are all employees now back in the office? So for our UK-based offices, so that's Linlithgow, our head office. We've also got Belfast office and our new Stevenage office. We operate a hybrid model, which means all staff members are asked to come in on a Tuesday and a Thursday, and then they have the choice to either work from home or work from the office on the other days of the week. So we find that works really well for collaboration and getting the staff together from a sort of cultural perspective on Tuesdays and Thursdays. It just gives people also some flexibility on the other days as well. We've always operated a remote model when it comes to our overseas staff. That's always been the case, even pre-COVID, just because of the spread of our sort of global reach. Our sales teams have always effectively worked from home or on the road, so we don't have any actual formal offices in any of our overseas locations.
Okay, and William asked, are you worried that China will steal IP on your products? No. And why do I say that with confidence? Especially our high-end products, if you take the lid off, you're not going to, you know, you can see what components we use, but that really doesn't solve your problem. You know, a lot of what we do in something like the Paragon is the market leader. It's really the knowledge of how to design these devices, and we base all our devices on FPGA type technology. So you need to get inside and figure out what's happening inside that. So, you know, we take the same philosophy with all our competition, you know, and that is, can somebody do what we can do? Probably, but good luck at trying to catch us. And that really is the picture I showed with Paragon. The fact we need to keep moving. If we just stop and stand still, then the world will catch us. But if we run fast, nobody will catch us. And that really is the philosophy of how we beat anybody, whether in China, the US, or anywhere. In fact, about 10 years ago, there was a US company that copied one of the early versions of Paragon. And by the time they came out and had a data sheet pretty similar to us, we already had a bunch of other enhancements. So we could basically say to customers, well, if you want last year's model, that's fine, but I thought you needed to test all this other stuff. And so really it's up on our own. It's down to us to stay in the lead by being faster than everyone else, stay connected to the standards, stay connected to the customer to make sure nobody catches up with us.
Gareth has asked another question. So do you have any hedging policy in place relative to your US dollar exposure? So we have some natural hedges already built into the business model, essentially. So we have some dollar-driven cost base when it comes to a large majority of our sales team outside of the UK. We also we have a dollar cost passed through to us, so the dollar effect cost passed through to us from quite a lot of the majority of our cost of sales originates in US dollars from our component from our outsourced manufacturer, and that gets passed through to us when the time is right from their perspective. So those natural hedges allow us to offset some of the US dollar exposure. We do work very closely with our advisors and treasury advisors on when hedging might be right. At this moment in time, we don't have any hedges in place because we feel that's right for where we are at this moment in time. But we do constantly look at hedging within the business, depending on where the US dollar and sterling are sitting at the moment in time.
Okay, Ashley, and the last question is Melville is saying, what can you say about your position in the market in relation to the other competitors? The first thing I would say, just for the avoidance of doubt, the kind of change that we're seeing over the last 6 months, 9 months, is nothing to do with competitive pressure at all. The competitive landscape really hasn't shifted very much over that period. So, but in general, if you look at our product lines, just maybe flick back here, just this easier one. Oh, press too many buttons. So the lab sync, as I mentioned, we are the market leaders in that. On the left, the lab sync products, we are the market leaders. We have a competitor in China that competes with the Paragon X, which is not as high accuracy as the Paragon Neo, but in the high accuracy domain, we are in the lead, so we have a strong position there. When you come to the network sync, obviously we get new products that have just come out that are unique in the market, so we have no direct competition, but we're also still trying to understand how big these markets are. The Sentinel, we are the only maintenance tester. There are what we call installation testers, which are more like a general purpose toolkit. They cover many technologies. They cover timing, but they also cover many other things. So really, we are unique, but our competitors that have installation testers very much argue that we're not unique, that you don't need a unique tester. A general purpose toolkit will do the job. So it's really our job to convince customers they need a specialized tester. And as we move forward into more into the mobile networks with far more density in terms of the number of radio heads, small cells, macro cells around, then we believe that message will become stronger and stronger. In the cloud and IT space, there are a number of competitors in some of these smaller segments. We are the only company that's got such a broad portfolio. And in some ways, especially, it was part of that reason to create these 3 platforms out of one base, was to give us a much stronger competitive position out there as well. So there is competition. We feel that at the moment we're in a strong position. I think we're coming out with some new things that hopefully strengthen our position going forward as well. And the last question, I think, which will be the last one because we're just about out of time. Can we say any more about the seed sales into the hyperscale? Really, these are into the R&D teams, so basically some of these other hyperscale, the telecoms world is a very mature industry. It's very predictable, as you heard me talking about the different interface rates. The data center world's a much younger industry. People are still trying to figure out themselves. So rather than looking to standards and copying or repeating what other people do, each of these guys are trying to figure out themselves. So these seed units are really into their R&D teams. We might sell the odd 1 or 2 more, but that's not where the business is. What we really are trying to help them do that assessment of timing and hopefully come to the conclusion they want to roll timing out across their networks. And that's where we've got the opportunity to create a much bigger return. In that market space, the biggest challenge with these guys are that they often quite like doing it themselves. So they have the ability at times to do it. So really it's more about persuading them, and that's partly where the relationships come in, that's saying, this is very specialist, you'd be better to let us do it and help you than basically use your own Indian resource to build that. So these are really part of the relationship building, and hopefully in the future they'll deliver significant extra business.
Tommy, Ashley, thank you. And I think you've addressed all those questions you can from investors. And of course, the company will review all questions submitted today, and we will publish those responses on the Investor Meet Company platform. Before redirecting investors to provide you with their feedback, which I know is particularly important to yourself and the company, Tommy, could I please just ask you for a few closing comments?
Sure. Well, thanks very much, everyone, for taking an hour to listen to us today. It's not the best, we've been in better environments for sales than we are today, but that's life. You don't always get it the way you want. But, the bottom thing, the key thing from my point of view is that the market drivers remain there, they remain strong. They haven't really shifted. There's macroeconomic effects. You can't be immune from what the rest of the world does. And we need to just work through that. We've got a great set of new products coming out. We've got low-level initiatives in terms of building relationships with customers. And we believe the market remains strong and there will be new opportunities for us going forward. So we continue to believe we're on a good track. We just need to deal with the short-term challenges. And hopefully in the future, we can soon get back to a more growing trajectory. Thanks very much for your time.
Tommy, Ashley, thank you for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete and I'm sure will be greatly valued by the company. On behalf of the management team of CALNEX Solutions PLC, we'd like to thank you for attending today's presentation. Good afternoon.